The world looks to California to answer the hard questions, for redemption, to introduce the unfamiliar, to be resilient. Because California bounces back, holds us accountable, values who we are, remains vigilant, defies those in our way, and stands for community. Here on the West Coast, we're at the center of it all. Los Angeles Times, the state of what's next.
Good evening to you, wherever it is that you call home. I'm Patt Morrison of the Los Angeles Times, and you're joining us for We Can Teach You That. It's a time series with our editors, photographers, reporters, and other experts to answer your questions about how to get along in Southern California. And tonight, we're talking about that. We're talking about home. It's one of the topics that dominates always in Southern California. We don't have much weather to talk about, so we can always talk about real estate. It's also one of the biggest challenges facing us here in Southern California. We know from the Twitter poll that you responded to that many of you are first-time home buyers, and you will have some questions, and we will try to answer them here. And we know the stress, the anxiety that home buying and home hunting can create, but it also can be, to use the words of some Times readers, emotional, exhilarating, and epic. So we hope that you will find this evening will answer your questions and be all of those things and more for you. So we're going to be joined presently by Yolandra McClinton, who works with the nonprofit Neighborhood Housing Services in Los Angeles County. We'll get into all the details, financing options, open houses, escrow, making an offer you can afford and trying not to make an offer that you can't afford, and some of the pitfalls. And there's a lot more to it. So this is information that's going to help you navigate this nerve-wracking, confusing, and unpredictable process. So we're going to be joined by Andrew Khouri. He's one of the Times writers behind our recent series, The Great SoCal House Hunt. He's been a 10-year Times veteran, one of the business writers behind that series. And Andrew, let's use a news biz word so you can tell everybody what's your beat.
Thanks for having me. My beat is the housing market, both the rental housing market and the for sale housing market. And my job here is to basically, talk to a lot of different people, home buyers, home sellers, renters, landlords, activists, organizers, researchers. To generally, what I try to do is explain why it costs so much to live here in Southern California and California as a whole, and what that means for people's everyday lives. And that's my job.
Let's start with the market. We don't mean the stock market, of course, we mean the housing market with what's going on right now during May. It's the peak of the home buying season. And we just heard the news in Orange County that the median home price in Orange County is, to quote Dr. Evil, $1 million. What is the market like? It always seems to be at a boiling point, but there's boiling and then there's boiling.
It is, and over the past 2 years of the pandemic, it has boiled a lot. You've just had a flood of people kind of entering the housing market. You have millennials increasingly entering their 30s, which is the time when most people buy a home for the first time. So there's just been lots of demand and people out there searching, and it's been really, really hectic. Prices have shot up, multiple offers, commonplace home selling for hundreds. Hundreds of $1,000s over asking. And, it's really, really, really tough out there if you're buying. Housing was expensive before this pandemic hit, but this has kind of, unleashed, an even crazier market, if that's possible.
Well, Home on the Range has that line about seldom is heard a discouraging word, but they seem to be very discouraging. I heard of a house in Pasadena where it was $1 million house and it went for $2 million. Somebody doubled the offer on that sort of thing.
So one thing helping contribute to that is, some people are not first-time buyers and they've owned their house for decades. They bought really low. They have tons of equity. They're selling. They're using that, and they're just plowing that all into that potentially $2 million house. And I don't know, they could be putting down $500,000 or even more to buy that thing. So kind of the general rise in home prices over the past decade or so is in a way kind of fueling more rises today.
It seems bifurcated then. You've got the sort of buyers who are on motorcycles and the buyers who are on roller skates.
Yeah, I mean, it's really tough if you're, on the lower end of, the price point that you're trying to go to. That's incredibly competitive. It's also competitive. You're going to be bidding against investors in some cases. So, it's tough. It's tough out there. Home sales have been increasing, so more people are buying a house, but it's sure not easy. And people are, being asked by sellers to waive, contingencies, which we'll get into later. But it's kind of things that are supposed to protect you and your money going forward. And buyers are being asked to take big risks when putting forth their offers.
And one set of statistics which really shocked me is across the country, half of Americans can afford a median priced home, but only a quarter of Californians. There are so many factors that go into this, but those factors really don't mean much if you're out there looking to buy a house.
Yeah, and some of those numbers have probably, since they were put out, have gotten worse. Actually, mortgage rates have really jumped up and made it even tougher for folks to afford a home. So, it's most people here in Southern California actually can't afford to buy a house. Many can, which is why we have prices where they're at. But a lot of people just are locked out of the market.
And it seems that every neighborhood now, virtually every neighborhood is $1 million neighborhood.
Yeah, we did a story on that a few months ago, and it was shocking to even me, who spends his life covering this, is just how many places now where most homes are valued at $1 million or more. You have places like West Adams, Woodland Hills, cities like Torrance are kind of all these areas that have recently, for the first time, kind of hit a more than half that homes are valued at least $1 million. And a lot of things are contributed to that. Incomes have risen. Mortgage rates for a long time were really, really, really low, and people have been paying a lot of money to become a homeowner.
Interest rates, boy, during COVID, it seems like they were flash frozen because the economy was kind of flash frozen. Nothing was really moving much of anywhere, and there were no concerns about inflation. But
Mhm.
now it's pedal to the metal with interest rates in the Fed.
They've really risen since the beginning of the year, and particularly in April. One thing we wrote about in the $1 million home story a few months ago was where rates were back last year. A mortgage payment, $1 million house was around $4,500, which was kind of what a $750,000 or $800,000 house would have cost you back in 2006, just because rates were so much higher then. Rates have since exploded. They're in the mid 5% on average. And if you were buying that $1 million house, say you were buying it at the beginning of the year compared to now, with the way rates have jumped up, your mortgage payment's going to be about $1,000 more expensive.
And that's just mortgage. That's not going into the principal on the house or anything.
It's just the monthly mortgage payment, so the principal and interest combined, and so and what you're going to be paying. I mean, one house got $1,000 more expensive, and so that is starting to take people out of the market. It has slowed down somewhat. There's fewer multiple offers. There's more sellers trimming their asking prices, but there's still a lot of people out there buying, and prices are still rising. Overall values are not declining at the moment. They're continuing to go up.
I just want to let people know that this would be the library in my dream house. It is not my actual library. So I too have a dream about houses. And so we'll be talking about some of yours and whether or not you can attain them, some of the tricks and insights that you can use in order to get an insider's advantage in some of these very trying situations. And that we learned from the series, Andrew, the Great SoCal House Hunt series. So what did readers and viewers tell you about what they found going on out there behind those welcome open house signs?
Yeah, I mean, what they told us was it was extremely, extremely competitive. They lost out on dozens of homes. They were getting, beat out by multiple offers, all cash offers. And then they also talked to us about just some of the general confusion around the process, which is kind of why we ended up writing the series. Is they didn't know what escrow was, or when they went through escrow, it was incredibly confusing, and they didn't know what was going on. People didn't know what closing costs were. They didn't quite know how much home they could afford. Like I said earlier, most people actually can't afford to buy a home in Southern California. But I've over the years have talked with people, interviewing them, and they'll tell me their incomes and how much debt they have and what they have saved, and they say they can never buy a home. And to me, knowing a little bit about mortgages, they very well could. And so there was just some confusion that for some people they could buy it and they just didn't quite realize it.
Is there any sense that the housing crisis of 2008, 2009 affected lenders at all? Because lenders were giving out mortgages that seemed like Halloween candy back then, and then it seemed impossible to get a mortgage as the market began to recover.
Yeah, so I mean, both lenders are more fearful of giving out loans willy-nilly, but also laws restrict their ability to just to do that. And so generally over the last decade or so, people have been taking out loans that, experts say they can more or less, afford. Some people might be stretching, but it's nothing like it was last time. And, so people are out there purchasing homes. And, if mortgage rates make it a lot more expensive, it's, one reason why a lot of people aren't predicting, price declines or anything like that, because the lending standards have just been so much tighter this time around than it was back in, '04, '05.
Uh, but Southern California is a big place, and there are a lot of places you can look to buy a house. Gas prices are high, so people would take that into account when they consider commuting. But a lot of people are able to work from home now since the pandemic. And there are condos, there are townhouses, there are tenancies in common. Can you talk a little bit about the range of choices of places and kinds of places to live?
Yeah, of course. So for decades before the pandemic, you had people moving from LA, Orange counties to the Inland Empire, Riverside, and San Bernardino for a place they could afford. A single family house with a backyard and within their budget. So that's definitely still true. A lot of people moved. The rate of moves out there picked up during the pandemic, as you mentioned. People don't have to commute as much. So if you're looking for an affordable place, maybe you live in LA or Orange County and it's a little bit out of your range, you can look towards Riverside and San Bernardino. There's also a lot more new homes being built out there. And so that will give you a better shot. The median home price out in the Inland Empire is probably about $500,000 cheaper than the counties along the coast. So that's one option. If you're looking in, Los Angeles County, Orange County, condo or townhome might be a better option for you if you find yourself struggling to get into a single family house. And in the city of Los Angeles, there's actually this new thing that you mentioned called a tenancy in common, which is essentially kind of like a New York City co-op. And they tend to be the cheapest, units on the market. They had drawn a lot of controversy in previous years because investors were creating them by converting existing rental property into that, so it often required tenant displacement. However, in the last few months, some new developers in the city have been demolishing owner-occupied single-family houses and building these new tenancy in common units that look like townhomes, and they're probably the cheapest in a lot of the neighborhoods. Now we're not talking dirt cheap, but in a neighborhood where the median home price is about $1 million, you might be able to get a tenancy in common unit for high seven, mid $800,000. So those are some of the various options, both in areas and types of product if you're looking for a more affordable place.
Are people feeling flexible because they're so desperate to get into the market? They'll consider a condo when before they might have said, no, 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 just a house with a garden.
Yeah, I mean, we talked to several people. That's the decision they made. So they start off looking for one thing, and they go from house to condo. Maybe they go from 3-bedroom to 2-bedroom, or area. Los Angeles, Riverside County, and so it's kind of just figuring out your budget and what you feel comfortable with, and what you can afford. Lenders, for the most part, aren't letting you just go wild with your loan. So you kind of got to work within your budget.
What you can afford may be different from what you think you can afford. As you just heard Andrew mention, we're going to bring in our next guest to talk about that. Yolandra McClinton, as I said, is the pre-purchase team coordinator with Neighborhood Housing Services of LA County. It's a nonprofit, a community nonprofit where she's been working for 20 years, and she teaches classes on how to buy a home. So we're delighted to get the advantage of her insights here tonight. Thank you so much, Yolandra.
You're welcome.
So talk about your work, what you see people coming to you, the kinds of problems you see, and the kinds of solutions that may be unexpected, but that are out there.
Well, let's keep it positive first. So, as I listen to you guys talk, one of the things that I always tell the students that come, our clients, is that your first house may not always be your dream house. But the key here is to get into the market. So in California, we understand that housing prices are higher than they are in other places across the nation. But in California, we pay for lifestyle. So the conversation just starts with them about What is the goal and what do they really want to do and what does the time frame look like? Let's create that because it needs to be a realistic look at if you can actually afford to buy in this market. But then we do the comparison. Purchasing a house might be expensive, but in California, rent is as expensive as well. So we've got clients that are paying 23, 25, $3,000 a month for rent. If they took that same money and invested into something that was theirs and maybe kept it 5 to 7 years, they could pull the equity and then be in position to actually purchase something.
And of course, a house and equity are such a cornerstone of building a family's wealth over time that I think that may be at least in the back of some people's minds. Is that right, Yolanda, that this is something of a legacy for your family?
So in my class, I do something that is called So That, because I realize that people come to class and they say, I want to buy a house. And I said, well, let's just kind of go through this, pull off a few layers. You want to buy a house so that. And then I take them through this exercise because when I find out in the end is that it's either something that it's like your why is always bigger than you. It's for generational wealth, or it's a retirement plan, or it's something else that's for their future. It's a great investment with a good return. But purchasing, we all kind of look at it. It's like that's one of the greatest investments you'll ever make in your lifetime. Housing prices continue to soar here in Southern California. So if you can get in, and we'll talk a little bit more about what I'm seeing in the market, I think you should.
Uh, then what do you tell people? How do you figure out how much people can afford?
So here's the key. There are three things that the lender is always going to look at. First, they're going to look at your credit. So, what does that credit look like? And it's more than just a score. So, how long have you had credit established? How many trade lines do you actually have open? What's the difference between what the credit limit is and the balance that you're owing? So, everything starts with, I call it a spending plan, but it's a budget. Oftentimes, we find people don't even know how much income they earn. They know what they bring home, which is net. But when we're qualifying you for a loan, we're looking at your gross income. That's how we're going to qualify you. So I encourage them to take the time, determine how much income they actually earn and how much debt they have. And because now we live in a society where we have multiple streams of income, we have to talk about that as well. So this might be your regular job, but if you've got additional streams or you're an entrepreneur on the side, then what does that look like? And how long do you have to have had that business established? How do I average that out? And then, of course, savings. So you've got to have some skin in the game. So it's your credit, it's your income, and it's your savings that's the foundation of where we start to make a determination about what is affordable. And I won't jump ahead, but the key is going to be that what we earn doesn't usually put us in position to compete in this market. And that's why there's something called down payment assistance.
Are people surprised when they sit down to work out their budgets to see what they have coming in and how the money goes out and for what?
Absolutely, they are. I call it the chip and swipe syndrome. So we almost have lost touch with money, and we're so used to just chipping that card and swiping it until it's like, I know I have money, but until you actually have a budget, and here's the key question. I say, how many of you have a budget? And people just, yes or no. And I was like, is it written down? Is it on a spreadsheet? Are you using an application or something? Because unless your budget is somewhere you can review it and make adjustments to it, it's not real. It has to be someplace where you can actually say, I'm overspending here, I'm going to make some adjustments there. It's the key.
You do see people using the cards for 79 cents for a soda or something like that. And you think, are they keeping track of this? At the end of the month, are they realizing that all their money went to X or Y? Now, it seems like it's chiseled in stone that you have to have 20% down. But is that really necessarily the case?
Not necessary at all. So there are so many other options, especially for our first-time home buyers, not talking about our long-term investors, but there are plenty of programs for first-time home buyers that will allow you to come in with as little as 3%. That's 3% of the purchase price. So if you're purchasing for $500,000, then that's $15,000 and so forth. Then there's also the option for FHA, which has always been attractive to some because they've allowed the lower down payment requirement of 3.5%. We will get into the difference in a bit, but yeah, there are plenty of options for them to come in with less money. And just sidebar, there is a program currently through the city of Los Angeles that will allow first-time homebuyers to come in with as little as 1%.
Now, Andrew, there's always an asterisk on this less than 20% thing. Can you talk about that?
Yeah, so usually you'll be paying something called private mortgage insurance, which is a kind of a percentage of your overall loan value. And that can range from, it could be under $100, it could be several $100, and it will really depend on one, of course, the size, how expensive of a house you buy, but also your credit score and exactly how much you put down. And this is insurance. It's not for you, but it's to protect the lender in case you default. And so it's there to protect the lender. And this will eventually go away once you kind of hit 20% equity. It will kind of fall off, and so you're not going to be paying it for the life of the loan, but you will be paying a little bit more each month to take out a loan without putting 20% down.
In the past, people took out mortgage insurance for their own benefit, but this is for the lenders now.
This is for the lender's private mortgage insurance. Yeah.
So what are the costs if you put down less than 20%? And maybe this is for Yolandra's. What kind of low down payment loans are there? Because there must be, not every bank, not every lender is going to accommodate a low down payment loan, right?
No, they're not. But to go along with what Andrew is saying, so if you find yourself in a position as a first-time home buyer, here's the benefit of the down payment assistance program. The programs usually offer, the ones that are currently offering, are somewhere between $75 to $100 in assistance. It looks like a second loan. Usually it's deferred, so the buyer doesn't have to make any payments on it. It's deferred for 30 years. Then with that additional assistance, it eliminates you having to pay the PMI or the private mortgage insurance, because that looks like you've put more money down. So that's the beauty of the assistance programs, and allows people to come in with just the 3%. Here's the other part. That's for conventional loans. For FHA loans, it's 3.5%, but you're going to have mortgage insurance for the entire life of the loan. So the rules changed back a few years ago. And regardless to what percentage you are as far as the house is appreciated or you've paid the loan down, you're still going to have mortgage insurance for the entire life of the loan. So the only way to get out of it would be to refinance into a conventional mortgage.
With the figure that you just heard, the figure about only 25% of Californians qualifying to get into the housing market, are these lower than 20% down loans making that figure a little wobbly? Are there perhaps more people eligible than would think they are?
So I know that data. It assumes that you have the 20% down. So actually, it's be a little hard to think on my feet here, but it could actually be a little bit worse because it's assuming people have 20% down and that their incomes would support the monthly mortgage. But if you put down 20%, you are going to be, if you put down less than 20%, your monthly mortgage payments can be higher. So, it could be a little bit worse than that data show.
And Yolandra, though, it must be news to a lot of the clients you deal with that there is even this option.
It is, and it's been around for a long time. So even with the marketing that we do, people still seem to be surprised that there is that type of assistance is out there and available. Here's the other side of that. It's based on income, and so not everyone will actually be eligible for it. But can you imagine that if it's designed for low income, first time home buyers, if you're a single person and you earn $66,750 a year or less, you're eligible. $66,000 a year is considered low income. And the programs range. So then as your household size increases, then the amount of money that you earn also up to help you to qualify. But the programs will work anywhere, and I'll just kind of throw this out, somewhere between 80 and 100% of the area median income, meaning a single person could earn somewhere between 66,750 up to $125,000 a year and still be eligible for the program.
Are there loan possibilities, mortgage possibilities if you simply don't have a down payment?
That you simply don't have what?
A down payment. Any programs that can help?
Not currently. So we saw this in the past prior to 2008 that there were programs where you didn't have to come in with any money down, but no. The lenders finally found out that if someone has done the work, made the sacrifice, been committed to the process, to have something to put in, it's not as easy to just walk away. So what we saw before when we had the mortgage crisis, that some people were just like, it's okay to walk away. I don't have anything invested. So now it's a requirement.
And adjustable rate mortgages look good and are probably starting to look a lot better as interest rates go up. The 30-year fixed is something you may dream of at 2%. But now with the changing interest rates and certainly a market as hot as this one, people think adjustable rates, that might work. Is that a good idea, Yolanda?
For my first time home buyers, we don't encourage it. It's a lot for you to already adjust to. So unless your income is going to adjust up and down, then we just know that you're more comfortable with including taxes and insurance in your payment and making sure that your payment remains the same. If you're a seasoned investor or buyer, then the adjustable rate, I see some benefits for it sometime if it's a short-term type of investment that maybe you're trying to get into. But for my people that are trying to make this their forever home, I don't encourage it.
Andrew, what do you hear from readers and questions about adjustable rates?
Um, I I hear people are doing it a little bit more. And so, yeah, as rates rise, it might become attractive to some people because they tend to have lower interest rates than the fixed term. But yeah, I mean, you really need to make sure you can afford, kind of ask your lender what, be very clear about what the adjustable terms are, when it will adjust, how much it could adjust if there's a cap, and you want to make sure you'll be able to afford whatever it could adjust to. These are a lot safer than some of the adjustable rate mortgages that we had around during the housing bubble, which sometimes had interest only periods. Those are mostly not around anymore. So adjustable rates are safer than they used to be, but you should still be careful and really think it through.
Now, Andrew used the term lender. I'm sorry, go ahead, Yolandra.
I'm sorry, I'm going to just say buyer beware, because every day we get information about what's happening in the current market. And Andrew, we just saw last week and this week, interest only adjustable rate mortgages being advertised. And we were like, they're back.
Interesting. Yeah, be careful with those.
Well, now you mentioned the word lender, Andrew. People don't think, oh, yeah, I guess I need a lender. Some people realize, gee, maybe I should get pre-qualified, but there are lenders and there are all sorts of different lenders. So how do you enter into that process? Is it a kind of courtship and you better pick the right partner?
Well, you should pick the right partner because you're going to be with this person given, well, one, you're going to be making the biggest financial decision likely of your life with them. You're going to be spending time with them because you're probably going to lose out on a lot of homes. And so what the consumer groups that I've talked to suggested about how to pick your lender is you want to obviously compare prices with several lenders, make sure you're getting the best deal you can, compare with at least 3 lenders, but also while you're sort of talking with them, kind of doing an interview with them really to make sure that they'll work with you. Look beyond price as well. So, make sure that this person is willing to, answer your questions, spend time with you, is easy to reach, and you feel comfortable with them because, you're going to be making a big decision with them. And, during today's crazy market, you really, you need to be closing on time. You might even work with your real estate agent to offer a short closing time period, and you got to make sure that your lender is going to be there and be able to close. and do that. So some real estate agents will recommend choosing a lender that is local, either that they're a small local company or they're a mortgage officer in a bigger lender, but is based here and they understand the market. Sometimes that might help you stand out with your offer because the seller will say, hey, we know this lender, we trust this lender, and maybe we'll go with them. So those are some of the tips that I might suggest.
Yolandra?
So here's the thing. Absolutely, Andrew. You should compare, should have at least three. But here are the important questions that you're going to ask when you're doing the comparison. So you're going to ask, what type of loan are they offering? Is it conventional? Is it FHA? Is it a VA loan rule? Then you're going to ask, what is the terms of the loan? Is it a 15, 20, 30 year? Are they offering 40 years? What kind of interest rates? And then the most important part is, what is the APR? Because that's going to be your best comparison. And APR is just going to include all the fees that are associated with the loan outside of the interest rate. So just remember that it's the APR. Ask them if they have any other special programs that they're offering for new or first-time homeowners, and is there a prepayment penalty? Those are the things you want to ask and compare with each lender.
It's a little intimidating, isn't it, for people to go into a lending, a mortgage company and have a list of demands? How do you advise people to approach this?
So here's where we come in. Neighborhood Housing Services has been around for more than 35 years. We start off with something as simple as a workshop called HOPE, and it gives information just for people to understand this is how you get started and this is what the lender is going to be looking for. Then we kind of progress into something called a home buyer education class. It covers everything from are you ready to buy through understanding a mortgage loan, shopping for the home, working with your realtor, closing the deal, and then protecting your investment. That way they have a basic education or knowledge of what the process looks like. They may not remember it all, but they know that there are some questions they should ask. We will be their first touch. We will do a pre-qualification to give them an idea of exactly how much they could potentially qualify for. And if they're ready to move forward, they want to work with a realtor, then we'll send them to get them pre-approved so they'll get that letter and they can start making offers.
I know it's a professional relationship, but maybe you should take homemade chocolate chip cookies to the meeting.
It's a great idea.
We'll be putting up links on the screen. You can go to latimes.com to some of the stories we've done in our series about the real estate market here in Southern California and find some of the tips that you're hearing about tonight. But I think what's uppermost in people's minds too is the competition. When you find that dozens and dozens of bids are put in on houses, and you go to an open house, and you find the house may already be sold, and it's only been on the market for a half an hour. And so, what do you do about the competition, and exactly who is the competition? Maybe you want to start this, Andrew.
Yeah, so the competition is there are a lot of investors out there at the moment. They make up about a quarter of Southern California home sales, which is an increase from what it has been in the previous years, but not quite as high as it was right after the Great Recession. But in most cases, your competition is going to be people like you, just everyday people trying to buy a house. And there are ways you can make your offer stand out. And unfortunately, the probably best one is to have more money, but most of us don't. So if you don't have endless amounts of savings to throw more money at it, there are some ways you can make your offer stand out. One of them is, and this is really more of a necessity, you're going to need to get something called a pre-qualification or a pre-approval from a lender, and this basically tells the seller that the lender is willing to preliminarily lend you the amount to buy the house. And no sellers you theoretically can make an offer without that one, but no seller is going to take your offer seriously. They got to take your home off the market, their home off the market, if they choose your offer, and they don't want to waste their time. So a lot of experts will recommend, if you're picking between those, pick the pre-approval letter. That's a little bit more work on your part to kind of prove your income and verify your assets, so that helps you stand out a little bit more. And the best thing that some agents say is something called a fully underwritten pre-approval letter, which just requires even a little bit more verification of income. And that will tell the seller that you're pretty good to go and will get this loan. Another thing that's become extremely popular during this crazy market that we're in is for people to waive contingencies or shorten their time you have to get these done. And in essence, contingencies are things in which, if you get your offer accepted, there are legitimate reasons you can back out of the deal without any financial penalty. The main ones are appraisal contingency, the inspection contingency, and the loan contingency. And so the loan contingency, you can back out if you can't get approved for the loan. Appraisal contingency, you can back out if the house is appraised for less than you offered. And the inspection contingency, if the roof is falling apart, you can back out of the deal. So waiving any of those or shortening the time frame you have to accomplish them can make your offer stand out, because the seller isn't as worried that the deal might not go through and you might walk away. But be very careful when doing this. Be sure to have a big talk with your real estate agent so you understand the risks associated with waiving any contingencies.
I think we've all heard stories of people who have waived contingencies, not just in the recent market, but over the years, and then who get in and find out, oh, the roof isn't really very good, or oh, the air conditioning system isn't all it's cracked up to be, and find themselves shelling out a lot more money than they had expected to remedy this. Yolandra, what do you have to say about these possibilities that make an offer look better but might put you in a hole?
I'm going to say ditto to what Andrew said. And the one thing, buyer beware. We never would suggest that someone waive a contingency for all the reasons that he just mentioned. And then if you're using a program where you're getting down payment assistance, the lender is not going to accept it anyway, because at the risk that they're taking by offering the additional assistance to help you get in there. But as a new buyer, you don't want to walk into something that's not really habitable. So when you're making an offer, I say make a good, honest offer. We do see most people are offering more than what sellers are asking for. Just be very careful about that, especially if we've given you a pre-qualification or pre-approval letter, because here's the question I ask more than what's shown on paper. Someone I have qualified for $500,000. And before I give them that number, I say, what's the threshold? What are you comfortable with? In your mind, what's the max that you would actually like to pay a month, including taxes and insurance? Sometimes they come back and tell me $2,700. And I'm like, that's not going to buy you a $500,000 house. So let's back out of this to where you're comfortable, and let's pre-approve you for something that you know that you can afford. Because if you get that deal and it's going to cost you more, then you quickly start to try to shift things within your budget. So the kids are in private school, but now the mortgage payment is higher. And so I'm going to put them in public school. And maybe I can just, take public transportation and get rid of the car. That's not it. You still have to have a life outside of the house. So make a realistic offer to whoever the seller is, and hopefully it will be accepted. If not, move on to something else. But please don't waive your contingencies.
Andrew, what kind of stories have you heard from readers about the competition as they go out on the Great House Hunt?
That sometimes the seller says, we won't accept any offers if you don't waive any contingencies. So some of that, which is, scary, because as you said, you could buy a lemon of a house. You're just losing out on a lot of the houses, dozens, people that have been looking for months, for a year, for more. Just the competition, basically, just how many people are out there, and how many offers you are competing against.
Do cash buyers always have an advantage in this market?
They often do. Sellers will typically like cash because it's going to close, right? You're not waiting for the lender, maybe you lose your job, whatever. It's cash closes, and it closes fast. Sometimes cash offers might be even a little bit under what you're offering, but the seller will still choose it because it's more or less a sure thing. So,
what about any kind of appeal to the owners themselves, even if you get to talk to them, like, oh, I promise that I will not tear out the bird bath that your grandfather built in the backyard? Something sentimental, something that matters to the sellers. How do you find that out? How do you appeal to them?
Well, a common thing has been to write a letter to the sellers, kind of explaining who you are, why you want the house, why you think you would be a good fit. Some agents and buyers themselves say they think this has worked, and sellers have chosen their offer because they had this lender, sorry, they had this letter, and the seller wanted to sell to them. At the same time, the Realtors Associations actually suggest sellers don't accept these letters because, if you're telling someone something about you, you might reveal your race, you might reveal your gender, anything that is supposed to be protected, and you can't be making decisions. The seller can't be making decisions, based off of the race someone is and choose them because of that, and so it can potentially open up the seller to allegations of discrimination. So there's that potential downside to these letters, but they do exist, and a lot of people do write them.
And have you heard some sad stories of, I'm sure many sad stories, people who bid and bid and bid and bid and house after house and just nothing comes through for them?
Yeah, they're still out there looking, and they have bid on dozens of homes, and they're getting discouraged. So agents will say, some people have backed out of the market because of that, and then they're kind of biding their time. And yeah, it's a very, very hard out there.
Yolandra, what tips do you have for people when it comes to the competition, not to get discouraged and to maybe give themselves a little bit of an advantage?
So location, location, location. And again, I say your first house is not always your dream house. There are so many. So our in-house broker would tell us that there's somewhere between 15 and 20 offers on every property. That's what the competition looks like. In my homebuyer education classes, I always have an average of 25, maybe 35 students. So that's what the competition looks like. And I have them look around the room. And that's what they're up against. Back to what Andrew was saying, a lot of the sellers, even when taking offers, they want it to be 30 days or less. Unfortunately, a lot of the programs that offer assistance are asking for a minimum 45 to 60 days. So sometimes that has their offer be pushed to the side because sellers don't want to wait that long in this market. So I tell them, don't be discouraged. I talked to a client yesterday. She said, I've made 32 offers. She says, I've gone outside of the area that I was interested in. She's gone as far as Lancaster, Palmdale, which would be a serious commute for her to get back to the city to work. And still, she continues to be outbid. And when we started a couple of years ago, pre-pandemic, she was thinking these housing prices are too high. Now upped the amount that she was willing to pay, $150,000, and she still hasn't been successful.
Yeah. Well, let's talk about a word that's kind of scary. A lot of them are in this process, and that's escrow. It means that I guess your bid was accepted, and now what? So, what do escrow and closing mean? What do buyers have to do? What's the burden on the buyer, and what should you look out for?
So escrow is one of the things that we heard was the most confusing for everyone, and it's because it is. And what it is essentially after your offer is accepted, you quote unquote open escrow, and escrow exists. It's a process that exists to protect yourself. If you think about it, you have your offer accepted. You and your lender don't want to just send hundreds of thousands of dollars over to the seller and expect the keys back, right? And so what happens is the first thing when you open escrow generally is you're going to take a portion of your down payment. Oftentimes in this market, it's 3%, and you're going to send it to a escrow agent, which is going to take that initial deposit called an earnest money deposit and hold it while you do a lot of things that you need to do, which is order the inspection, which is make sure you're not going to use one of your contingencies to back out, make sure you get the loan fully approved. And then, so as you're sort of doing this, the escrow agent is there, she's holding the money, and you are signing a lot of documents back and forth from the lender, the escrow agent, your agent. And so it's just kind of a lot going on during that time. And during this time, you also have to sort of order some services yourself. You got to pick the inspector, pay the inspector. You got to order the appraisal that's usually done through the lender, and you got to purchase your homeowner's insurance and show proof of that. And then you'll eventually get all this done, hopefully, and sign the final loan documents, and then your deal. Once you send the rest of your down payment money, your deal will close, and you'll be a homeowner. But there's just a lot of moving parts, and so be sure to ask a lot of questions and make sure you're in full communication with the agent, the escrow agent, and the lender. So you're all on the same page and hopefully proceeding to closing without any major hiccups.
It sounds like there could be some thin ice in this process, like maybe if the appraisal doesn't come back as everything you had hoped it was going to be. What are some of those pitfalls, those thin ice spots?
One of the, oh, Yolandra, you want to go?
No, go ahead.
One of the main ones, I think, is the inspection, right? So you're going to be ordering this inspection. You're going to have the inspector show up, and they might tell you there's something wrong with the roof. Might be something wrong with the foundation. And then at that point, you have to decide, hopefully you still have your inspection contingency. And if you do, you have this time frame where you got to tell the seller whether you're proceeding forward with the deal, you're fine with whatever the inspection found, whether you're backing out of the deal totally, and then you'll get your earnest money deposit back, or if you want to negotiate and say, okay, well, we're still willing to buy the house, but this foundation repair is way too much. Can you pay for it yourself, seller? Can you bring the sales price down, and then we'll proceed? So there's a lot of decisions like that. The appraisal contingency, a lot of people have been waiving that because prices have been rising higher and higher. And surprisingly, in our reporting, I've asked a lot of people whether folks had a problem with waiving that, or they ran into issues. And I didn't talk to anyone that did have issues, but the inspection contingency is a very important one, of course, because you don't want to buy a house that's falling apart.
Yolandra, what pitfalls do you warn buyers about?
So the thin ice or the contingency that Andrew is talking about is usually the first 14 to 17 days. That's usually the period of time. So you can make a pretty good determination, because if you get that appraisal done within that first 2-week period, then it doesn't waste the seller's time nor yours, because you'll understand exactly if the house is what you think it is, if it's got issues, and if there's some negotiation to happen with the seller. But escrow, honestly, just dots every I and crosses every T. They are the liaison between the seller and the buyer. They collect the information, make sure that everything is proper and in place. And so for any of our newer first-time home buyers, I encourage you to breathe, have a lot of patience, but have all your documents where you have them easily accessible, because as they ask you for information, you want to be able to just have it PDF and sent directly to them. But this process that you go through for 15, 30, 45 days for closing is probably, honestly, the most stressful time, because they ask lots of questions and they ask for some of the same documents over and over again. But remember, this is for your protection. So going through the escrow is really like a safety net for you to be protected.
Yeah, this is, I think, maybe the most stressful part, because you think you're elated that your bid was accepted, and then you lie awake at night and look at the ceiling and think, oh my God, what am I getting myself into? Yolandra, you must have some advice for people about how to de-stress and how to calm down through this agonizing period.
That is our everyday conversation. So my favorite thing is to breathe. Just breathe your way through it. So why do they continue to ask me for my paycheck stubs? I've already given them to them. Why do they want to know where the money comes from? So here are the things that we tell them not to do. Don't go out and do shopping. Don't use the credit cards. Don't take on any additional debt. Even if Home Depot is having a great sale on appliance, pay until 2025. Do not go out and change anything in your credit profile while you're going through this process. I've had a few deals recently fall out because people didn't have enough established credit. They want to be debt free. They've closed accounts, and they have 2 trade lines, and the lenders are saying, we need you to have 4. 3 to 4 open trade lines. They want to see who's extended credit to you. Do you pay? Do you pay on time? And it has been heart wrenching to see people get to the point where their offers have been accepted. And then for something as small as, and listen, it's not just for the main buyer. If you're buying with someone else, this young lady was buying with her father. He didn't have enough credit established, but she wanted to use his income for the transaction. The deal fell apart.
So can they come back? Can they remedy that and have another bite? But the house they want's already gone.
It would have to be a really quick fix.
Yeah.
Yeah.
So let's talk about what people have available to them as advice and guidance, the resources that are out there that they may not even know about. So, Andrew, maybe you can walk us through a few.
Yeah, sure. So some of these resources out there is the California Association of Realtors has a website where you can kind of look up what down payment assistance programs exist, and you can click on it. You can put in your income, where you want to buy, even what kind of job you have, and it will spit out what's available to you. And so it's a pretty good resource to sift through, as I think they describe it, more than 400 down payment assistance programs in the state. That's a lot for people to sift through, so this will help. There's also the Department of Housing and Urban Development maintains a website where you can look up housing counselors in your area, which is what neighborhood housing services is, and who Yolandra works for. And these people will either for free or sometimes a small fee will walk you through the whole home buying process, give you classes and hold your hand, and then hopefully at the end of the day you'll end up a homeowner.
Yolandra, what else would you suggest?
So there are a number of programs that will offer assistance. And it is on a first come, first served basis. So there might be hundreds of thousands of dollars, and it might take a while for them to be exhausted, but there are programs. So for instance, the city of Los Angeles has a program called LIPA, L-I-P-A. It's low income program assistance, and it offers up to $90,000 for the first time home buyer that's low income. They have one that's called MIPA, M-I-P-A, that's for moderate income, and it offers up to $75,000. These properties have to be located within the city of Los Angeles. There's another program for the county of Los Angeles that's called Cal Home, C-A-L-H-O-M-E. Cal Home offers up to $100,000. And when we're talking about assistance programs, all they're saying is that they're layering this additional money on top of what you can qualify for to increase your purchasing power. So Cal Home offers up to $100,000. Most of these programs are specifically for single family dwellings. That means a single family house, a condo, or a townhouse. There are additional programs that come and go. Sometimes they're in the forms of grants. Currently, there is a closing cost assistance program through CAR. It offers $10,000 specifically to help cover your closing costs. Some of the lenders might offer a program called WISH. So when you're out there looking, you always want to ask, if you're talking to a particular lender, what kind of programs do you have available for new or first-time home buyers? I would say that if you Google down payment assistance programs, you'd probably come up with a lot of information, but you have to be careful because a lot of the information that comes up is already expired. And then occasionally the funds can come from maybe a private lender. And there was back a few years ago, pre-COVID, I believe it was up to $30,000 that Wells Fargo was offering in the form of a grant, meaning you could use that money to help you with down payment and or closing costs. You live in the house 5 years, it was totally forgiven. So they continue to create these kind of programs. They come and go. If one is exhausted, just know another one is coming soon.
So being persistent about it and asking the right questions.
Yes.
I didn't ask, and I should, about pitfalls in terms of lenders and mortgages, because I'm sure there are unscrupulous ones out there. Are there some red flags that people can look for to help them know, don't go there?
Yeah, reviews. Look at the online reviews. I mean, if a lender is horrible, that might show up. If your mortgage broker is horrible, look at that. There's also some government websites that will, if you look up your lender, and Yolandra might maybe will know the exact website, but if they've been there's sued by the state, if they have disciplinary action against them. So those are some of the red flags. And if something doesn't feel right, if someone's not willing to walk you through the process or take the time to explain things to you, that's another red flag. So make sure they'll give you the time of day.
Yolandra?
If it sounds too good to be true, it probably is. Ask the right questions. And so don't sign documents unless the information is already filled out. Don't let them tell you, we'll come back and we'll work this out with you later. There are a lot of hard money lenders that are out there. I have a client right now. She's in a 13% interest rate loan. She didn't realize it was only for 3 years. And so we've worked through some programs to help her save her house. But higher than what you're hearing on the news every day. So Andrew said earlier, we're at about 5.5%. If someone's offering you a 7% loan, beware. What other kind of fees are associated with it? And so while we're seeing these things raise their head again that we noticed back in 2005, 6, 7, 8, we're starting to see a lot of them come back again. So Neighborhood Housing Services is a HUD certified counseling agency. You don't have to necessarily want to obtain your financing through us in order to call and just ask questions as simple as, here are my documents. Can you look at them with me? Does this make sense? And in addition to that, there are a number of lenders that are offering something called a non-QM, meaning a non-qualified mortgage, meaning their rates and things are higher. Before they can loan, their client has to come to a HUD certified agency, have us look at the documents and explain it to make sure that the client knows what they're signing, not to tell them to sign it or not, but just so that they're aware before they do it.
There are a number of resources that the LA Times series on the Great SoCal House Hunt has put together. The Times Affordability Calculator you can find at the latimes.com website. There you see the link there. And also the whole series is available online, the Great SoCal House Hunt. So you can look through that to find out the anecdotes, the decisions, the kind of advice that might be relevant to you and your decision. And available for sale is a print version, a abridged print version of the Great SoCal House Hunt guide that you can get on the LA Times website. So my question for each of you will start with what's next. It seems to be every month, even every week, brings some different news about the housing market. As we're moving into the summer, people want to be settled before the school year starts, for example. So what are the cycles of anxiety, opportunity? Andrew, you talked about maybe the higher interest rates are having an effect, not a good one for a lot of buyers, but are affecting us nonetheless.
Yeah, so I mean, all of a sudden, people can afford a lot less house, and so that is taking people out of the market. You are starting to see inventory rise a little bit, mostly just because homes are sitting on the market for a little longer. Not that there's like a flood of new listings. So if you're going out there and looking, it might be a little less. It might be more. It will be more expensive probably for you than it was a few months ago, but it might be a little calmer. You might not be bidding against as many people as you were. And so, if you can stomach some of the higher prices, maybe you have a little bit better of a chance to get into a house. One question people always will ask me is this, the higher mortgage rates mean prices will decline? Economists I've talked to say unlikely, although it should drastically slow the rate of home price appreciation. So maybe instead of 15% price appreciation over a year, we might see something like 5 or less, but we'll just have to wait and see. No one knows for sure.
Is this a bubble? And all bubbles eventually burst. Is that what a lot of people may be thinking and waiting for, Andrew?
A lot of people are thinking that, and probably a lot of people are hoping maybe that happens if they haven't bought a house yet and they can buy. Experts generally say no, it's not. This time around, it's way more supported by incomes and what people can afford. The lending standards this time around are just way tighter. And what happened last time, the reason why we saw such huge price declines was you had a lot of foreclosures, you had a lot of short sales, and people were forced to sell. This time around, we're not giving out loans quite like we were. And yeah, you might be stretching to get in a house, but people can more or less afford it. And so if you get into trouble, you're not going to be forced to sell, and prices probably will remain generally where they are. Maybe they could dip a little bit, but a lot of people aren't expecting drastic price declines because a lot of homeowners have a number in their head where they would like to sell. And, if they're not going to get what their neighbor got a few months ago, even though they might make globs of money, they're going to hold on and try to get that price that they want. And so they just might not sell.
Yolandra, what do you see ahead?
So, what I would advise, just be patient. In this housing market, the one thing that we know is that we also service those that are already homeowners and for the post purchase. And the one thing that we noticed while everyone went through this pandemic and they were able to obtain forbearances, some people still haven't been able to recover from this pandemic because of loss of income or a loved one that had additional income. So we're telling them, the new home buyers, to be patient. And we're thinking that probably after the first of the year, we're going to see a shift in inventory because unfortunately for some, they're not going to be able to keep their homes and almost forced to sell, which could be a great thing because they've got lots of equity, but it will make more units available for the new home buyers.
And for a lot of people, renting is an equally expensive option. You obviously don't have, you have a first and last month, but you don't have a down payment of 5, 10, or 20%. But we also see the rental market is very expensive. And we have corporations who are buying up big swaths of rental housing all across the country. How is that affecting people? I'll start with Yolandra on that one.
Definitely a huge effect. And so we're finding that more people aren't able to even afford to pay the rent and they're being forced out of apartments. So that's why I said in the beginning that those that I see that are paying 2,500, 3,000 and more a month in rental payments to try to find something that they can invest in. I actually had a client today. She found a condo in Long Beach, $285,000 with a 240,000 association fee. I think it's a one bedroom, one bathroom, but affordable than where she was living.
It's a start, Andrew, and that's what a lot of people are looking for.
Yeah, I mean, people are trying to get into a home they can afford, and yeah, you might have to make sacrifices for that. But as rent keeps rising and rising, it can be harder to do that, right? I mean, if you're throwing more and more of your income towards rent, that's less and less you have to put towards a down payment.
A lot of the questions that we've been getting from readers have already been answered, but here's one for Yolanda. I'll put to you. What advice do you have about buying a duplex? I,
Thank you for
I
asking
presume that's
that.
like a one to live in and one to rent out, right?
Absolutely. If you have an opportunity to buy multiple units, it's a great thing. I mean, you've got someone else that's helping share make that mortgage payment. There are programs, and we're waiting for them to come back that offer down payment assistance to help you even with that. And so for multiple units, a duplex, a triplex, or even a 4-unit building, remember the guidelines usually is that it still has to be owner occupied. You have to live in one of them, but you can 75% of to help you for the loan. So you're not alone. That's a great investment. And just FYI for anybody that's looking, just know that you see so many new developments that are popping up. And we are starting to hear more talk that it's a requirement for each new developer to set aside a percentage of those units to make them affordable units. So sometimes there may be a little bit lower than the current market rate, or they're offering some type of incentive. But if you see them starting to dig ground or put up boards, look at who it is. Usually it's Olson's or KB Homes or Heritage Housing, something like that. Just make sure that you're paying attention to what's coming up in the communities you're interested in.
So follow the hard hats and the bulldozers.
Yes.
Andrew, we just have a few minutes. What kind of advice would you wrap up with? Where should people be looking apart from the LA Times, and what should they be looking for in these months?
I mean, I would recommend HUD housing counseling agencies is what many experts recommended to me. It's you can look it up on HUD's website, and these people really will walk you through the whole process at free cost or free or a very low cost, and it's a resource that a lot of people don't know about. So I would go with that. Also, we were talking about low down payment loans earlier. If you are a veteran, you actually can get a loan through or backed by the Veterans Administration. Sorry, Department of Veteran Affairs, but for 0% down. And so, if you're a veteran, you might want to look there.
And Yolandra, some of the same advice, but also there's an emotional content to this, a kind of hand-holding that people need through this process.
Yes. And that's something that our agency does. So we start the relationship with you in the workshop. We walk you through everything in the homebuyer education class, and then you are assigned your own individual counselor to help you along this path towards homeownership. So some of our clients have been with us for a couple of years, just getting them in position to be able to compete. And so I would encourage anyone to go to our website. We have workshops twice a week, Wednesday evenings and Saturday mornings. We offer the homebuyer education class either via Zoom or you can do it online. There is a small fee for it, but that's the only fee that you pay. And all the counseling and everything else is absolutely free. But we want to make sure that we have you in position so that when you go to the lender that you are pre-approved.
Well, there you are from some of the people who know best about this. The Great SoCal House Hunt is what the Los Angeles Times has been covering in a series lately. You can go to the LA Times website and find it. Find an awful lot of resources, affordability calculators, even a print version if you want to walk around with it and check off the to-do list and all of that. So thanks so much to our guest, Andrew Khouri at the Los Angeles Times, the business writer who's been covering real estate, and Yolandra McClinton with the Neighborhood Housing Services. Both of you have been offering sound advice, guidance, and some consolation, I think, which everybody needs under these circumstances. I'm Patt Morrison. We thank you for watching tonight. We hope it's been very helpful. And from our virtual home to yours, good night.
Good night.
Good night.